Dear students, this video is going to cover economic risk and how it impacts the macroeconomic decisions, especially when you do business in foreign countries, and how political risk, government regulation, and other things such as inflation and instability will impact the bottom line. So pay attention, you're going to need it. Managing economic exposure. Economic exposure management is a set of methods that companies can use to handle economic risk, also known as operational risks. This is a potential impact of adverse exchange rate fluctuations on a company's cash flow or a new competitive position. It can be managed through operational strategies, currency risk, mitigation strategies, operational strategies, diversification of production, and the product markets and financial sourcing and stuff like that. But in order to figure out how to do all these things, you have to know and understand the different tools and gauges to actually predict what is going on in the macroeconomic world. By studying different data points that are collected and provided by government agencies and other organizations, we can figure out where we are, where we're going, and where we have been. It gives us a type of top-down analysis of the world around us. It will let us know what the gross domestic product is, the GDP, the employment numbers, inflation, interest rates, budgeting deficits, fiscal policy, monetary policy, business cycles, sector rotation, and leading and lagging indicators, for example. Because finance is forward-looking, I will spend more time at looking at leading indicators. Those are, for example, the average weekly hours worked in manufacturing, average weekly initial claims of unemployment, manufacturers' new orders, consumer goods, materials, index of suppliers and deliveries. Wall Street also provides lots of good information by allowing us to watch what's happening in the stock market. They're forward-looking. They're betting their livelihood whether or not businesses will make money in 3 to 6 months from now. Interest rates are also very important to watch. All the leading indicators will help you understand where we're going and what we can expect in the short term, from quarter to quarter. Now, different industries perform differently depending on where we are in the economic cycle. As we move into a recession, for example, investing in healthcare, staples, or utilities will be very defensive by nature. To understand why financials is a good place to be, you have to understand duration. We'll cover that in future videos. Once we go through the economic cycle and bottom out, technology, discretionary spending, and materials will be very important to allocate your funds in if you're an investor. As we have an expansion, we typically industrials and energy will do really well, including telecommunications. This cyclical investing strategy follows kind of roughly the GDP and the interest rates, but it's going up and down. So this is economic boom, and this is a recession. If it's really deep, it's called a depression. So as things go bad from the peak, and always recession always starts on the top, and then it falls down, which means that you would sell, or chemical papers and medicine is good to buy. As we go down, we should probably avoid international investments. Gold is typically very popular in these baskets, so that means that if you're in the gold sector, you will do well during this period of time. As we get out of the recession and go in and out, retailers, housing stock and auto stocks and so on, they typically are inexpensive, and you would like to buy it because they will start making more money as we get out of the recession. Now, this is all from an investor's point of view, but it also means that the businesses, the different sectors here, utilities, materials, healthcare, they know that they have ups and downs in the economy, and their stocks will go up and down depending on where we are in the economy and where we are in the economic cycle. To understand fiscal policy, we also have to understand the rules of the game. When it comes to investment, several regulations that have stayed intact since the Great Depression are such things as the 1933 Securities Act, or also known as Blue Sky laws, that has to deal with crowdfunding. That's one of the restrictions that is imposed on startups that are looking for funds so that they can grow their business. Glass-Steagall was repealed and replaced under President Clinton. It was replaced by Dodd-Frank Wall Street Reform and the Consumer Protection Act of 2010. Other very important rules to pay attention to is the 1934 Securities Exchange Act, the 1940 Investment Company Act, and 1940 Investment Advisor Act. Well, if you're not in financial services, why do you have to care? Well, if you have shareholders, you have to care because these rules govern what you can and cannot do with the shareholders' money. Some of the economic exposures that will affect a company are exchange rates and interest rates. If you do business across border lines and you have to deal with a different currency, you have to understand the economic exposure that currencies have on your business. The biggest part of exchange rate risk is applied to the firm's competitive position. Would someone like to buy a bicycle manufactured in the United States or imported? It has to do with what price is the underlying currencies and the other circumstances that bike built in a foreign country is built in. So economic exposure can be defined as the extent to which the value of the firm would be affected by unanticipated changes in exchange rates. Economic exposure is partly the sensitivity of the future home currency value of the firm's assets and liabilities and the firm's operating cash flow to random changes in exchange rates. And it has a lot to do with interest rates. That's why you have to pay attention to the bond market. A good definition of operating exposure is the extent to which the firm's operating cash flows are affected by the exchange rates. So how do you manage all these risks? One way is selecting a low-cost production site or finding a flexible sourcing policy, diversifying into different markets around the globe, or doing research and production in different locations. All of these things can be financially hedged through options and forward contracts. Now, building something at the lowest possible price is very important. It's a way to actually make the money on the buy, on your operating expenses. Because if you can make it inexpensive enough, you can always make money. But if you have an expensive product to build, it's very hard to sell that at a higher price when your competitors are cutting you off with a similar product at a lower price. At the end of the day, the like, wants, and needs of the consumer will drive your business. Selecting low-cost production sites is very relative. So, assume that there's a firm out there that wants to diversify the location of their production sites to mitigate the effects of exchange rate movements. It could also have to do with trade barriers, interest rates, and different regulations that pose a risk to the overall business and the bottom line. Honda, for example, decided to build vehicles in the United States in response to a strong yen, but after a while it found that it was importing more cars from Japan due to a weak yen. Now that makes it a very interesting problem. Here they're building cars in the United States, and they are more expensive than the cars that they actually manufacture in Japan. Same vehicle, just it is different from what market is actually produced in. So by choosing a different manufacturing location, you can actually decide on avoiding certain risks such as trade barriers and so on. But at the same time, you have the risk of currencies that makes the same product cheaper across the border. Just like there's economic cycles in different industries, there's also economic cycles for different countries. They don't always move together. Some countries are doing really good while others are suffering. And some countries are then later on doing well while the other country was doing a little bit worse. It goes up and down. Because of this, there's always a benefit of having sales in multiple markets. Exporting your products or the locations of production will take advantage of the economics of scale, and it will diversify the risks, which makes your variabilities of production more even. It costs a lot of money hiring and firing people. That's why a company wants to keep their employees, because they are trained and they know how to do the work, and it's much more affordable to keep them in the long run than trying to retrain people that they have to lay off when the economy picks up and they need to rehire new people. The old people might not show up to the same business again. When it comes to research and development, it's a different way of focusing on how to create intellectual property, yet figuring out how do you structure costs. How do we enhance productivity? How do we create a product differentiation? Just think about Samsung and Apple. They're both cell phones, yet they're trying to tailor their likes, wants, and needs for their customers, and by offering slightly different ways of experiencing the cell phone. So when it comes to cell phone, just think about it. What would you want in your next future cell phone to make you go, wow, I need to turn in my old cell phone and buy that brand new one because it's awesome. It has everything I want. And that has to do with research and development and planning for future expansion and increased sales. I hope you liked this video, and if you did, give me and follow my page. I also suggest that you take a look at my playlist that has awesome, fantastic videos on stuff that you want to watch. Okay, lots of good econ stuff. People like Ray Dalio, Milton Friedman, Carl Icahn, Shark Tank, and other episodes that I think you're going to totally enjoy and help you better understand the economic world that we live in. So, see you soon. Take care. Bye-bye.